Hey guys, so welcome to the new lesson. So in this video, we'll focus on the Treasury essentials and particularly yung all of the functions that are enumerated here, of course. And of course, we'll just focus on I think the first two or three of them for this video, and we will continue to proceed with all the others, not really explaining what they are because those are for masters, but also for more particularly for discussing the issues and how you would be able to function as the manager of the business manager, considering the treasury and controllership function. So first of all, we have positioning, treasury and management accounting, treasury and corporate strategy, capital structure, business operations and stakeholder relations. Yes, we've discussed that in the previous video. Cash and liquidity management, again we've discussed this, and if you look at all this, it is somehow related, it's more aligned to like financial management and aligning the strategy to the scorecard. This is the financial perspective, most especially if the person doing the financial management and doing the controllership is not really an operations guy, which is in our case in the Philippines is almost always the case. You become like the controller of the company because of your CP background or because of your accounting background or finance background, but then you don't know anything about the controllership. You don't know anything about the operations of the company. Is that a better a scenario, or what is better? Is it better that you are an operations guy, you know the operations, but then you lack the skills of finance, and therefore you lack the skills in the controllership situation? Of course, there's always not it's always not the case that you have the proficiency for both. You always favor one over the other, and in certain situation, the owner of the company, especially the ones that are in charge of the board members, the incorporators, the owners of the business, and the president, of course, the CEO, will be the one that balance the decision, when it comes to deciding which path to follow. And all these concepts about treasury and controllership would factor in the background, like, okay, these are inputs and what are the things that we should follow. All right, so there is also cash and liquidity management. Your idea, you want to invest in something, but then there's cash problem, there's liquidity problems. How would you able to survive in the next couple of months, quarters or years if you will proceed with this kind of a business, for example? So those are taken into consideration. And sometimes if you're an operations guy more than you are a finance guy, right? You understand finance but you're more into operations. Then sometimes you sacrifice the one for the other, no? More so if you're a marketing guy. If you're a marketing guy, like take the case of Apple computer. When Steve Jobs, focused so much on the Mac. He was so engrossed in improving the Macintosh, so much so that he drained the company of so much resources, and they're not able to sell anything anymore. When the Palm computer during those times went into a massive, sellability, and the PC is running amok. They have no answer for the Windows. They don't have an answer for the Palm computer, and they were just focusing on the Mac. And surely because Steve Jobs is a marketing guy. He was really into, you know, putting something that would eventually, you know, raise them into saleability again. And of course, he failed miserably in that regard, and he was kicked out of his own company because of that. Which, of course, in the long run became a good thing. But those are the scenarios that are to be considered. Okay, so there's again there's treasury operations and control. There's considering of the system, treasury in financing risks. Okay, so because of your investment, and then the financial risk management and risk reporting, especially when you do the annual report, and as part of your report to the board, of course you have to make them understand how you are able to combat the risk, or more or less mitigate the risks that are present in your investment. Governance is also there, right? Sometimes you should report about this, in the sense na you're able to control what's going on in the board, who's in charge of who, are there conflict of interest in the business. Sometimes also, especially when you are running a financial services company, there's awash, the company's awash with cash, awash with liquidity, and there's always the risk of in the bank we call it dosary account, a loan for directors, officers, stakeholders, related instruments. So dosary, of course, it's a no-no, and you have to have an integrity board. Sometimes you really have to consider that in order to protect the money of the shareholders. And governance is really a trust issue, especially in big corporations, and it's usually the start of a downfall of a company if you don't have integrity in the board. Okay, so also there's treasury accounting. These things are pretty basic. Okay, so let's focus first on the positioning, treasury, and management accounting. So it says here that the key role of the treasury function is to advise the board, as we said, on the business decisions and financial consideration that are fundamental to corporate strategy. So there are many things to consider, and usually the problem with, again, I'm saying this almost as repetitively as possible, because it's always the case, right? Usually strategy is favoring one aspect of the business and then letting go of the other. You know what I mean? So when you have an all-out war, all-out expansion, then sometimes you are missing out on the fundamentals. You are missing out on the home base, right? You are busy conquering the world, and then you are forgetting that the brand in your own country is also dissipating, right? For example, when Jollibee started to focus on the international market, of course they realized that the food industry in the Philippines is a bit shaky still, right? And just a flick of a hand, you can lose your branding, your leadership in the market. And when you go all out on an international, massive hunt for the global brand saleability, and sometimes you forget that hey, the biggest market is here in the Philippines, and therefore you have to focus on that. And there are many examples of that. When KFC, for example, started to do marketing, for example, in other countries like Japan or China, they had to even rework the brand. They rework the colors, because certain colors are not appealable, or are not appealing to certain countries. And these are the things that, as a controller, as a treasury guy, this may not be part of your job to give inputs for, but it is important that you know these things. And that is why the major break down, especially in giving inputs to the board and management, is when you know nothing about the external environment. So even if you are, and almost always this is the case, even if you are an introverted, an introvertive kind of guy, like most of the finance guys that I know, you should be able to talk to operations people. You should be able to talk to the external environment, because all your assumptions should not be only based on the historical context. I'll give you an example. No, when you create, for example, a costing, right? And what happens is that, okay, these are the givens, these are the input. Okay, give us the costing. How much are we going to price this? If you don't have an operations guy, an expert, if you don't connect to the operations person, there's a tendency for you to base your assumption on historical values. There's nothing wrong with that, but then when it comes to the reality of the case, then when you price yourselves outside of the market, especially if you don't have a connection with the marketing guy, then it's either you price it too high, or if you don't understand how operation goes, and you're just assuming that everything will be as is the case historically, then you are pricing your product very low. For example, from the perspective of the cost plus profit thing, right? So it's almost always the problem of communication. So really have to trash out everything, and it's hard, especially for the controller who stays in the room. Yes, you connect with them only during meetings, and in meetings you cannot trash out everything on a flick of hand. So you really have to exercise judicious communication, so to speak, and understand it from their perspective. And sometimes it's easy for you to assume things, especially since you don't get to talk to these guys for a long period of time. So that is the reason why from the very beginning you really have to have a good team of experts, and the assumption should be clear, so that you should not price, you will not be able to price your product outside of the market too high or below the profitability line. So those are the things, right? So strategic level, Treasury is about advising, but sometimes, because they are so important, you cannot launch a product without their approval, because they have the money, they know how much you're able to shed out for that project, and therefore sometimes they are just an advising function. They have the advising function, but whatever their advice is, it's almost always the end all and the be all of the decision. And the reason is they have the money, they know how much you're able to put into the project. So with that, it's always a tricky part, no? Especially if the company is so focused on the bottom line, and so focused on cost reduction, you tend to forget that you cannot just focus on the shrinking thinking and not let go of the expansive opportunity that's at stake there, and all because you have the wrong assumptions, because it's easily forgone, especially when you cannot forecast how much you're going to earn when you offer that product. Especially, for example, if look at let us look at the example of Apple. When first they launched about in the 1990s, in early 2000, I guess, the iPod first, right? 1000 music in your pocket. So when first they launched that, they are not sure that the market is going to buy that at the price that they put. I guess about $500 or something like that. When they started to market the iPhone 4S, iPhone 4, They don't know that it will sell like, hotcakes, and then, it will be the start of the uh, Apple dominance in the market. Imagine if you are a controller kind of guy, and you are not, and you're the head of Apple. Imagine if Steve Jobs is not a marketing guy, and he's so concerned about, the cost. What would be the return of that? How is the hurdle rate? If you're so concerned with that, then there will be no iPad, or there will be no Mac to to offer to the market, simply because you cannot be sure about the return, right? So in the strategic level, Treasury is all about just advising on the appropriate choices, the trade-off, especially the trade-off. Are we going to focus on speed, reliability? Are we going to focus on excellence or cost reduction, something like that? So because everything actually that the company is offering is going to have an impact on the future direction of the company. Right? So there are three strategic and interrelated questions, and these are fundamental to treasury decision making. So first, what should we invest in? So there are always many options for this, especially if you are on the operation side. Okay, this sounds good. Now in a school, maybe we should package this program like this, etc., offer it to the international market. Those are options, right? So those are strategic options. How do we fund these investments? Okay, do we borrow from the bank? Do we issue shares? Do we just put in more capital as shareholders? Ask the current shareholders to shelve in some capital again. Those are options wherein you can fund your investment. Are we going to sell some of the asset of the company, like when Ayala sold Pure Foods, right? And when the John Gokongwei Group sold Digital and Sun, right? So those are decisions, and those are ways in order to fund your investments. How do we manage the risk of our choices? So there is a computation of return, and there are decision trees that you can consider when doing this. No, I'll do that the third part, in another video. But let's focus first on the projected return of your investment in this video. So let's focus on that, and okay, so let's just focus on that. I'll open an Excel file, and I'll give you an example of a decision of investment, an investment decision. All right. So for example, you are planning to invest in 2021. All right. So this is 2021, and you are going to have a 5-year horizon. So 5-year, considering that 2021 is already starting. So 2022 is the first year, 2023, 2024, something like. So investment would be around 10 million. All right, so this is in thousand, so let's just put it as 10,000. So 10 million worth of investment. Now, the first thing that you have to understand here is the cost of capital. So how much is my hurdle rate? How much should I return? How much should my return be in order to make this a worthwhile investment? So let us just assume, again, of course, in real life, you have to compute that. All right, so this is not a financial management class, but or a management accounting class, but you know already your hurdle rate. So for example, in the cost of capital, you computed that your hurdle rate should be around 15%. So this is your return rate that you must focus on. So when you do that, and your 10 million investment should earn 15% a year, then that means this should be the value, right, of the investment of 10 million through the years. So it should be 11.5 million in 2022, 13.225, and I've just computed by multiplying the previous year by 0.15, like this one, right? Okay, so it means that by 2026, the value of the 10 million should be 20.1 million. So almost double your money in 5 years, right? Now, of course, if you know this, you should compute for the earnings that is attributable to this endeavor or this project. So you are computing net profit, and then at the end of the 5 years, maybe you are able to fully depreciate all your assets that you use in this business. So for example, you started your factory, you opened your factory, and all the things that are put in that project is able to generate a net profit. For example, a net profit after taxes, after depreciation of about, this is the case, right, of about let's say, okay, so this is tricky, okay, 5, okay, so 6 million. So this is your earnings per share, earnings, this is your earnings, net earnings, net income. Let's put it as net income after taxes, after depreciation, right? So net income of the projects. So 6 million on the first year, and this is projected, right? So and then on the second year, 6.5 million. Okay, and then 7 million on the third year, 8 million, and then 10 million on the 2026. So the question is, was this a good investment? So remember that in 2026, all your assets is fully depreciated because you depreciated only in a 5-year horizon, and so there's a tendency for you to just add all this. Oops, circular reference, sorry about that. Okay, so at the end of in 2026, you've already accumulated 37.5 million. So if you will look at it this way, then you're able to say, oh, it's already an earnings. We have already produced the required earnings because the return rate is only 15%, right? But then there's a present value idea, because so remember, what 10 million in 2026 is not the same as our 10 million today. So you will now adjust, and this is called the discounting cash flow. Now you are going to adjust all your future earnings to the current year 2021, right? So now in order to do that, you will now adjust the present value formula. So present value formula would be, and this is now using again, broad estimate of the inflation rate. So why is this the case? So it's like saying, okay, 6 million next year is like how much this year. Okay, so what would be the factor? So it would be the present value factor, considering using let's say only 5% inflation. And of course, this is an assumption, and you may go wrong on this, especially during a pandemic, during a slowdown of the economy. You have a problem, right? So 5%, okay, so that's 1.05, which is 1 plus I, right? 1.05 raised to okay, So raise to 1 year. So raise to 1 year, which means raise to the -1, because you're going backwards. So it's like this, raise to 1. So I'm going to give you this Excel file so that you'll be able to use it, right? So meaning your 6 million is only 95% of the value in 2021, right? Now the factor for year number 2 would be 1.05 raised to 2, which is 90% only, and raised to 3, and then raised to 4, and then raised to 5. Okay, so what will we do with this factor? You will just multiply this 6 million with the factor. Okay, and then you will you will just add it. So 37.5 million over the course of 5 years is like having 32 million today's money, right? And remember that 10 million today, using the present value factor, using the 15% earn that we said, you have to multiply the 2026 value of 10 million and then convert it to the current year. So that would be multiplying by 0.78. So that means 20 million in 2026 is only 15 million in today's money. So if you earn an equivalent of all this, that's already 32 million versus the 15 million. Of course, again, assuming 5% inflation. Okay, what happens if the inflation is 6%? So if the inflation becomes 6%, then all of this will change. Alright, so it will change 6%. There's an easier way to do this, but I'm just using it so that you will see where I am converting it. So 6%, okay, so it's like having 31 million today's money. Again, still a good investment. Okay, what if our return rate is not 15%? What if it becomes 20%? No, I don't like 15%, because 15% is just the minimum. I want it at 20%. So if that is the case, then we're going to convert it to 20%. So now our hurdle rate says that we have to earn 24 million at the end of 2026. So 24 million is the net asset, right? And that is like having 18 million in today's money. So if that is the case, converting again on the discounting cash flow on the right side, you will see 31 million is our present value using 5% inflation if we have all this net income, right? So again, it's a go, right? So this is the way you are going to formulate your advice to the board, right? Now, maybe if that is the case, then maybe the board will question you, how come your projection is too high considering we have a return rate of 20%? Maybe your assumption of the net income is wrong. So that is where your decision tree will come in. We'll discuss that in the next video. But you can adjust this, the net income that you projected. Maybe this is too high. What if we just earn only half of it? So 3 million, okay, or maybe 3.5, okay, 4 million, 4.5, and then 5 million in the last year. So when that is the case, if for example, your certainty of earning this is decreased because of the pandemic, decreased because of the status of the economy, then if this is only decreased up to 50% of your projection, then it's like only earning 16 million in today's money. And if you compare that to the 18 million required because of our return rate hurdle, then we can say that this is a losing proposition. You lose 2 million, right? Now, of course, you can adjust because of that. Okay, so maybe because we are conservative, we'll just use the hurdle rate of 18%. And then you adjust again. So instead of 20, you convert it to 18%. And you have 17 million. Again, this is still low compared to the projected return rate. And remember, your return rate a while ago is about 16% or something like that. And if that is the case, then you will say that this project is good only if the economy is going to be great. If the economy is not that great, then we have a problem. Now, all this is now going into the decision of the management, and then of course the management will say, okay, let's go for it, but then let's input another thing into the projection. Because remember, we projected about 6 million, right? So let's just say, okay, we won't be earning 6 million, maybe about 5 million only in the first year, 5.5 on the second year, 6 million on the third year, 6.5 million on the fourth year, and 7 million on the last year. 7 million on the last year. So this is a good scenario already, right? 25 million present value using 5% inflation. No, I think this is already using 6% inflation, which is not going to be the case because usually the inflation is about 3 to 4% only. Of course, if there's a pandemic, then that changes a lot, right? Now, the question now of management would be, okay, how do we ensure that your net income would be this high, considering that you only invested 10 million? That's like saying you're earning 50% already of the investment. ROI is 50% on the first year, 55% on the second year. Isn't this too high? Of course, the answer would be, of the marketing people will say, okay, let's factor in aggressive marketing here and we will be able to do this. Operations guy would say, okay, let's reduce the cost of production so that we can still earn better net income. So it's like all the three functions, main functions, right, of the company are putting all their thoughts together, their heads together, in order to come up with a good decision on whether to pursue the project or not. So this is an example, a very simple example at that, but an example nevertheless of how we use hurdle rate that we learn in financial management and in management accounting, how we input economics, the function of economics using inflation, present value theory, and also how the other aspects, the other functions, functional departments, other functional heads can put in all their expertise into the project in order to make this a reality. All right, so that's it for now, and let's proceed to the next video. And I'll be using POMQM, right? So I'm going to share with you a download a site of the POMQM. This is using PC, so I'll be using my other laptop for this. So I'm just using it. I'm just doing it a little later. So I'll give you a download link for the POMQM. You can download it. It is for free. It is free to use, and it has been helping me for almost 10 years already, right? And there's so many things that you can do there. So I'll teach you how to use that, and we will input some decision tree into the you know the decision matrix using what we discussed here. So that's it. Thank you very much for listening. See you in the next video.